Hi, so in this video, we will be discussing the complete system that is described by Mark Minovini in his book Trade Like a Stock Market Visit. And with that, I will teach you the setups, practical details about the setup. Even if you have read the book, you will get a lot of practical knowledge. And with that, you will also get 2 or 3 scans. One will be fundamental based scans, and the remaining will be technical based scans with logic so that you can even make one for yourself. So in this video, first we will cover something called as a SEPA, based on which we will be seeing the fundamental template that I have personalized for you. Then we will be looking at the fundamental scan. I'll also talk about the technical template that the book talks about and what are the problems with that template and what you can do, what I've personally done, how I will help you in this video to make your life much easier. And then based on that template, we will build a few technical scans which are shared in the description. So please go over there and use those scans from there. Once we are done with the fundamental and the technical part, we will then look for practical examples on the chart. After which, I will give you case studies and there will be a part 2 of this video coming before the end of this year 2023, wherein I will share a few good stocks to be tracked of this particular strategy. So let's begin with the first part called as the SEPA, and the full form for which is Specific Entry Point Analysis. It's a strategy of precision described in the book. So we'll see what is the objective. So you can see it here. The objective of SEPA is to take all the pertinent information available, and the important point is pinpoint the precise spot at which to enter high probability trade in terms of risk versus reward. This is where the key lies in this book, in the SEPA, that your focus as a trader, as an investor, is to pinpoint the spots, the areas in the chart where the probability of your trade working in your direction is high and which also offers a very good risk versus the potential reward it has to offer. This is a key. I'll talk about this in detail when we see the charts, but just keep this in mind that if you truly get the core concept behind it and keeping this principle in mind, you work on the charts and devise your strategies, you will definitely see that there is a lot more the stock market has to offer. So what Mark has done is in SEPA, he has combined fundamentals along with the technical behavior of a stock. And this is what makes it a bit unique. Although there have been books before this as well, but what Mark has done is he's really used only the fundamentals which are very necessary and then clubbed together with very precise entry points and pretty practical strategy points he has given in this book in terms of technical. So that is what it makes it even better. But if you have gone through the book, if you have not gone through the book, you will see that when you read the book, you read it 2-3 times, but then you go on to the charts, you are just not able to get the best out of the book that it has to offer. So this video is focused on that it will basically declutter a lot of things for you. It will make things very simple for you and very practical for you. And if you simply follow whatever I've taught in this video, the tools that I'm going to give you, you are definitely going to make a good success in the markets. So in the SEPA, he talks about 5 major elements which are as follows. The first one is trend, and this is a key. See, what he says is the strong growth stocks will always give you a clear uptrend. Now, what is a clear uptrend? We'll discuss that in a bit. But for now, just keep this point in mind, clear uptrend trend during the aggressive growth stages. The author also says that this is identifying. The trend identification is very crucial because there are only 2 steps for this. The first one is you have to determine the stock is in which phase of the rise. If you have not seen the Stan Weinstein series, please do check that series out. Because in that we talk about the phases that the author has talked here in great detail. And then there is whether the stock price conforms to a trend pattern, right? So what you will do is in the phase, you will check the moving averages And when we talk about the trend pattern, basically what he's saying is higher highs and higher lows. Then the second point is fundamental. He says that the driving force behind the rise of strong growth stocks mostly comes from improvements and growth in the company's fundamentals, which are earnings, revenues, and gross profit. So he also says that you will see that these improvements will happen before the explosive growth in the stock price occurs. So see, the thing here is, although I'm somebody who doesn't use fundamental a bit because I'm a trader who looks to trade for 2-3 days, but anyways, this is I believe going through the fundamental, it is a good way to scan for the stocks. If not buying or selling decisions, but at least you can have a good list of the companies, of the stocks where you should be focusing upon. But in this video, I'll give you the scan for that. And the second thing also is that let's say even you don't want to get into the fundamental of the stocks and all that. I'll also give you a technical scan which will actually take care of all these things, and we'll see how technicals also relate to the fundamentals. Technical by themselves can show you a lot of things. Then the third is special events. Now this is very special. He says that stock prices need special events that excite investors. Now in the book, what he has written is the stocks will experience significant rally by having stories or events. Okay. And these are the events which basically interest the institutional investors. Fine. So basically what he says is there could be government policy, there could be a new product development happening, something new coming into the markets, consumer behavior shifting, right? But what I say is there one more very, very important aspect that happens on the charts, which is a technical term that I will teach you in just a bit. And then he talks about the entry points and exit points. Both of these I'll talk in detail because we have a dedicated slide for all these 5 points. So let's go on and read about all these 5 points in very specific details. So the first thing that we are going to cover is the fundamental template. Okay, so here are around 10 points and I'll explain to you how they are, where you can use them. So the first point is your earning per share's latest quarter should be greater than the earnings per share in the preceding quarter by at least 25%. Now, where are these numbers coming from? Well, if you have read William O'Neill's work, How to Make Money in Stocks, because even Mark has mentioned a lot of times about this book that he has borrowed heavily the concepts taught in this book. So basically, since Mark himself is coming from this book, it is always best to refer to the original source. So what I've done here is I've taken the template of the fundamental to make things a bit clear for you and incorporated that with the Mark's understanding. So the first thing he talks about is EPS latest quarter greater than the preceding quarter's EPS by 25% at least. Then he also talks about the EPS growth for the last 3 years should be more than 20%. Then EPS of YOY, that is year on year. Today's whatever the quarter you have compared to the last year's same quarter, there should be growth over there. Now how much growth? I've not put a number over here, but I think this filter is absolutely fine. Then the fourth point is sales in the latest quarter should be greater than the sales preceding quarter. Why the sales part is important is, see, what can happen is the earnings can be manipulated by the companies through a lot of ways. I will not get into those details, but it is always good to see a healthy trend in the sales along with the EPS, because at times you will see that the company is actually not able to sell its product, sell its services, but yet you see the earnings are rising, right? So that is a way to inflate your earnings, and those happen through a lot of ways. But that is why, keeping sales as well in your filtering is very crucial and important, as it could protect you from those kind of shady things happening in some companies. Then the fifth point is important, that is your market capitalization will be less than 5,000 crore rupees. Since we are talking in Indian market terms, I'm using 5,000 crore rupees. Now see, what is important about this is you will see that most of the companies which have a market cap in higher numbers, let's say for this more than 5,000, what will happen is those companies will not show you a lot of growth in short period of time. They will show you the growth. I mean, if the company is good, eventually it is going to show you the growth. But the point is, we are looking for performance in a short duration of time. What happens over there is, since there are a large number of different kind of holders, everybody has a different perception towards the company, different objective towards the company. So what happens is, they face much more selling pressure. While when the companies are small, what happens is a very small amount of people or group or investors track that company. And that small group itself is able to drive a lot of demand on themselves. So because of that, what happens is the element of additional supply coming in that stock, which has the market capitalization in a lower number, is much more, right? But it also has its own problem. If the market capitalization is really small, what can happen is it can be easily manipulated as well. So what you can do additionally is you can put another query, similar market capitalization, but that market capitalization should be more than 100 crore rupees. You can put it if you want, but I'll also tell you how to avoid those companies just by looking at the chart. But this is why the market capitalization is used, and how this is you can manipulate it according to your needs. This number could be 1,000, 4,000, 10,000, whatever you prefer. Then the sixth is basically now we are moving into a little bit of technical filter criteria are involved because they are really basic. So the thing is, volume of 1 month average should be more than 50,000 shares. Again, you can play around this number according to your capital, whatever you need. But 50,000 is a decent number for 1 month average of volumes. Then the seventh number is current price should be more than 20 rupees, because you will see that below this, majority of the stocks are penny stocks. They are heavily manipulated. And those are circuit operated stocks. So you will not even be able to find buying opportunities. Then the eighth point is RSI greater than 40, because if you are not aware of the RSI, you can just leave this point just like it. If you are aware, you will probably know why greater than 40. Then the current price of the stock should be greater than the daily 200 moving average, because it is believed conventionally that a daily 200 moving average is like the last line for the bulls. Although I don't believe, there are different implications of this thing. But generally, you will see that the stocks which will give you high growth will be above their 200 daily moving average. So another filter, if you wish to keep it, you may. Otherwise, you can remove it. The 10th point is basically about the timing. Because see, when a stock has its 50-day moving average greater than its 200-day moving average, usually they'll be doing, strong momentum phase. That is only when it happens. If the 50 is below 200, definitely the momentum is just not there. When the 50 is above 200, and preferably the current price is above 50-day moving average, that is where you will mostly find your buying opportunities. So having this filter is definitely going to help you cut that number down. So now let's go to that scan. Let's see that scan working. So now we are at the fundamental scan, and the website that I'm using is Screener, and probably the best website out there to scan for the stocks through fundamental queries. And there is also one advantage of Screener over the charting that we use for technicals. I'll tell you that. See, the charting database only has the NSE stocks. They don't have the companies which are only listed on the BSE. And BSE still has some really good companies with good liquidities, would give you good opportunities. So if you only rely on the charting, those are the companies we miss on. What good thing about Screener is that Screener and their database have the NSE as well as the BSE companies. So what you can do is, just by running this simple scan of fundamentals of growing companies, you can get the companies that are either listed on the BSE or NSE, both, right? So you can see I've written this, whatever queries that we saw in this slide, I've written down them here, and I've run this query and see how many companies you have gotten. 36. So your job is to do nothing. Whenever the earnings season is over there, every month, and probably I'll say, just run this scan, get the list of the companies. We'll get 30, 40 companies, or most of them would be the same, and just keep a watch list of these. And that is how you can basically have really good companies with you through the simple scan, right? Now, let's say you want to make some changes, you want to expand this scan a little bit more, and you say that, okay, well, I do want the companies with market capitalization below 5,000 rupees crore. But I also want those companies which have market capitalization more than 100. I don't want those which have market capitalization less than 100. Basically, these all companies. So how you can edit this query, I'll show it to you. So you go here and simply copy this, paste it over there, and put 100 over here. That's it. And type and, right? Once you have written it, your query is now done. Now through this, what can happen is only the companies with market capitalization within this bracket will come to you. So let's try it out. Let's run this query. And now see, those companies with market cap more than or less than 100 have been removed. So this way, let's say you want to play around, and let's say you want the companies 10,000 market cap, right? That is how far you want to go. You run this and you get 34 results for these companies with the highest market cap be 9,493 crore rupees. So yeah, this is a great scanner to look for the companies fundamentally, right? And this is a very basic queries that I've written here for you. And this is how simple this scan to run is. Just type in whatever you want and you will get it. Although I've already done the work for you, what you can still do is, let's say you remove this. You remove this from here and you run this query. Now see how many companies you will have. Okay. When the last query is there, you just remove the and as well. And press the run, and now you are getting 77 companies. So that is other way to expand your search results. So I hope this is clear, and you can sort it out as however you want, however you wish. The best way I would say is to simply go by the market cap and look for the opportunities in these stocks. So this was basically the fundamental template and the fundamental screener. The link to these is in the description. So here let's discuss all these points one by one and see the importance of those. So the first thing is he says that the current stock price should be above the 150-day and 200 moving average. Now I don't agree with this because in my setup, in my personal trading, I do my buying near to the 200-day moving average or at times even below that, because those are the areas where you should buy. It's a little difficult to understand because it is a little complex, but anyways, this is what I'll tell you. But what is the way around it? What is he trying to say? See, generally 200-day moving average is considered as a last line of support for the bulls, right? If it is above it, you are bullish. If you are below it, you are generally bearish. That is what is called, right? But let's read a little bit more about what he says. Then he says that the 150-day moving average should be above 200-day, which simply means that you should have some good momentum in the long term as well. Because when 150 is above 200, that means that in the long term, because 150 and 200 are really long moving averages, that means your long term is not in a downtrend. It could be in a range or it could be in an uptrend, but that is all it. The third point says, which is important, that 200-day moving average line is trending up for at least 1 month, preferably 4-5 months minimum in most of the cases. What does he mean by that? See, he's basically saying that the slope of 200 moving average should be like this. That is the upslope. What does it mean? Well, it is simply telling you that the longer term trend, which we talked about, if you remember, right, in the first slide, longer term trend is positive. That is what you want. And that is what an upsloping 200-day moving average for 4-5 months implies. And that is what you want. Now, see, if this is the condition, then generally what you will see is your price is above 200-day moving average. You will see it in most of the cases. And which means, the first point, you can even ignore that. Because if you are looking for this, most of the cases, you will automatically get the price above its 200-day moving average. Okay. This is important. Why is that? Because see, if 200 is downsloping, that simply means that your long term is negative trend, which means you will not get super performers just like that over there. If your 200 is flat, it's not going anywhere, which simply means that the stock is in a range. So you will not get moves like this because you are in a range. And when the stock goes into the uptrend, that leads to the upslope of the 200. And that is why this slope has been given here. That is the importance of the fourth point here. And this is applicable to any kind of moving average that you use in any kind of trading you do. Okay, the fourth point is the 50-day moving average should be above both 150 and 200. Now, what does he say? See, as we will move forward, we will look into patterns like VCP and these kind of patterns, right? This is what we will learn. But even before that, the hint is given over here. What is the hint? See, when we talked about 200 being upslope, the long-term trend is mostly taken care of. When we say that the 150 is above 200, again, the medium-term trend, you can say, is taken care of. But now when we say that the 10-week or the 50-day moving average is above both 150 and 200, that means you are also taking short-term trend to be positive, or at least in momentum, short-term trend. This is what he implies by the fourth point. Because if my 50-day is below 150, that will imply that even the short-term trend is negative against a positive long-term trend, which implies that the stock will take a lot of time for first 50 to go above 150. The cross will happen, and then, you will get your VCP, and then you will get the opportunity. So the best time to buy will be here and not anywhere here, because that could remain in range for a long period of time. So this is basically what the author simply means by saying that the 50-day should be above 150. Then he goes on to say that the price is trading above its 50-day moving average. Now, what is the importance here? You will see that, let's say the stock performs greatly right here. You will see that this entire area, I'll mark it, this entire area, just before the move is about to happen, the move is about to come, this will happen above its 50-day moving average. Which means through this point, point number 5, he's basically timing the entry to precise point as he talked about at high probability rate where the risk reward is in your favor. This is the point that it talks about. Well, then we have some simple points of stock price being at least 30% above its 52-week low. And the 7th point is current stock prices within at least 25% of its 52-week high. The 8th point, it's not very relevant, I'll say. If you have a stock which checks all these 7 and the technical scan that I'll give you and my technical modifications I'll give you, you don't really need 8 points. So you can just let it be for now. But what I'll give you one activity is try to combine the point number 6 with point number 7. Tell me if both 6 and 7 are in check for a stock. That is, it is satisfying the 6th as well and the 7th as well. What does it mean? I'll tell you. Let's say the stock has been in a big range for a long period of time. Right? What will happen is its 52-week low and 52-week high will be very near to each other. When he says that it should be at least 30% above its 52-week low, he basically says that in the range that you are, you should have some prior buying force when you are consolidating. Because in the range, if you don't have this move, then how do you know that there are buyers with you in the range? True. So in the range, if let's say you are consolidating like this will be a 30%. And let's say this is your 52-week low and the price is somewhere here. This will imply that you are here, that you have some buyers with you on the left-hand side, which is very important, very important point. Then in the 7th, he says that the stock price is within at least 25% of its 52-week high. Now see, if a stock is within its 25% of 52-week high, in most of the cases, you will see the 0.6 automatically satisfy. But there will be points where the number 7 doesn't satisfy, but the number 6 does. So what I'll say is treat these 2 points differently. So if you stick with, let's say, the number 7, right? The number 6 will automatically be taken care of. But if you stick with the number 6, the number 7 doesn't necessarily need to be satisfied. If you stick with the, let's say, number 6 only, what will happen is you will get a lot of stocks. You will get a lot of stocks because 7 will be included in that, because you haven't put any number onto that. And I think that is a better way to scan if you want. But I'll give you a different scan which will make your life easier. And if these things seem a little complicated to you, well, they'll not be anymore. So basically, this is all about the trend template. Very simple and very basic. Now what we'll do is we'll look into the chart and what you should look for, what you should avoid. So see, here I have given you 3 simple points which are my modifications of whatever the Mark has given in his book. And this is the simplest. Let's go point by point. The first thing I'll tell you is check the trend on monthly or weekly chart. By this, see, if you want the stocks which move 100%, 200 or 300%, basically high percent numbers, you will have to pay a lot of attention to the monthly chart, specifically, a lot of attention. And then comes the weekly chart. So your job is to check the trend on the monthly and weekly. What exactly to do over there, I'll tell you. See, the first thing you look for is 10 EMA. It could be of the monthly or the weekly. Preferably, go for the monthly. On the monthly chart, you will simply have to look for the 10 EMA crossing or diverging from the 20 EMA, and following which you get a consolidation at 10 EMA of the monthly time frame. Okay. So what I'm trying to imply, say over here is, see, what happened here is, if you observe this area of the chart, here you see 10 and 20 were very close and the price was being volatile around it. After that, what happened? See the strong buys that came. Okay. After which what happened? The 10 and 20 started to go away from each other. Distance basically increased. Also, one thing, if you see that there was a resistance here, you can see, which we broke above. Okay. Then what happened? There was a pullback or a contraction, consolidation to the 10 moving average. That becomes an important area for you to pay attention. And along with this, you have to see that your 50 is greater than 200 of the monthly or whatever time frame it is, with both the slopes being positive. 50 and 200 should have positive upslope. Why is that? Because see, 10 and 20 can be above each other even in the cases when they both are below 200-day moving average. And that is not what you want, as I've explained. So you want these conditions to be fulfilled on the monthly. Now, when you have seen this on the monthly, now the time is to simply buy the stock. How do we buy the stock? I will tell it to you when we discuss the live case studies once we are done with these presentations. But this is a very basic, simple scan that I've made and I'll share it with you. And these are the exact criteria. So you can check that out in the description. And also one thing, if you mention, Mark has given that you have to avoid the ranges. So see, you can clearly see what a range does. If you will see, the price was looking like it is breaking out, but well, the moving averages were all together and flat, correct? And then what happened? You again went down, very volatile, you again went up, and finally a move came which took the moving averages away from each other. After which you got a really great area to buy. How to do that? Don't be concerned, I'll tell it to you in a few minutes. But then once we had an uptrend, that is where we are required to participate in the stock. Why is that? Because see, this is the area where the maximum growth happens in relatively shorter period of time. I mean, just imagine if you draw one line from here to here, right? That is, it is starting almost from May 2020 to, let's say what? This is almost the 2023 end, right? So almost 2.5 years or so, it gave you some price movement, but took you 2.5 years. And in 1 year, simply see the growth the stock gave, right? So this is basically what we are looking for. Now let's talk about the special events. So here's the key. Well, the first thing is obviously government policies. You will see it happening with the sugar stocks in the Indian markets, even in the bank stocks. These are the sectors where, the government implements a lot of policies which can have a positive as well as a negative impact. So you have to be aware of them if you want to be. The second thing is a lot of global events keep happening in the world. So they have a really big role in how the companies perform, how do they do, how their economy do. The third point is the important and the special point. See, well, these two things are something that by the time you'll come to know about them, the stock would have given up its ideal entry point in most of the cases. Or by the time you'll know, if you're tracking these, you will miss the ideal entry point, right? You will be exposed to a lot of risk. The thing that will really help you is one thing. That is the crossing of moving averages on monthly occurred due to a robust bullish candle accompanied by substantial volume. How will it look like? I've shared an example here with you. See in this stock, this is basically a monthly time frame. What happened here is 10 was below blue line, 20, then 10 crossed above 20, and see this candle was very decent candle. We had high volumes accompanied. Then we had a contraction to 10 moving average with very low volumes, after which you got really good 2 candles move, right? This is a monthly time frame, so this is around 40-60% that you are looking at in just a matter of what? 2 months. So why did this happen? Because there was a special event of monthly 10 crossing above 20, and see the alignment of 200, that is a red line, and green line 50 moving average. Both are in upslope. This is the key point. When you have these conditions met, you will find really good stocks. And these are the stocks I'm going to basically share with you in the part 2 of this video, which will come as I've told you. So now you know the government policies, global events, things like this are talked in the books, but this is something that I've created and I've given to you. So take care of this thing and always be mindful of these kind of stocks. I'll show you a lot of examples which will certify this point of mine. Well, then it comes to the entry points, and this is where the book really goes into a lot of depth. So if you really want to get the understanding of what exactly the book is talking about, you can definitely go through it. But now I'll talk some practical points. I'll give you practical points. See, if you see, there is one thing that is very much used in the book, and that is called as patterns. Now, you know what is my take on the patterns, about the volatility contraction patterns. I have a dedicated video to this, so please do check it out on the channel. So see, the simple thing is patterns are very simple to learn. They are something visual. The key lies here is in executing your trades, that is taking buying and selling decisions within them. That is where the key is. Everybody can identify the patterns. How it is? Let's see. So basically with patterns and execution, there are 4 cases. The first case is, let's say your pattern is right, you have identified it correct, but you executed at the wrong time, at the wrong place, within the right pattern. What will happen is, either you will be having unnecessary losses, which shouldn't have happened in the first place, or even if the trade works out, you will underperform. Clear? Wherein you could have made 50-80%, you will simply make 30% or 20%. Pretty poor. Then the second point is, let's say you are wrong in identifying the pattern. You did some mistake, but your execution was right. What will happen is, since your pattern is wrong, definitely you are going to face some losses. But the thing is, this will lead to minimal losses. Why? Because your execution is right. Now, right execution in itself is a very, very big thing that takes years to learn. But if you can do this, your execution part right, in the long term, you will see that your performance will be much, much better than anybody else, just by having the right execution. Even at times when you are wrong with your patterns, you will be taken care of by the right execution, and that will only lead to a solid, good performance. Because that will simply complement your winners much better. That will not take a large part out of your winners, which usually happens with people. Then the third point is, let's say you identify the right pattern and your execution was spot on. This is the case which simply leads to super performance. And this comes with a lot of training in right execution. And then the part is, well, the pattern is wrong, the execution is wrong, this will lead to disastrous performance. The market is going 30% up and you are in drawdowns. This is something that can happen. So if this is happening, nothing to worry about. It's simply that you are getting your patterns wrong and even your execution is right. Just take care of these things and you will be on the path of super performance, or at least much better performance. So the first thing you should get right is right execution. And once you are good with that, focus on the patterns. So now here are some patterns in front of your screen. Let's talk about those. So if you see, I've written some things which you might be familiar with. The first thing is VCB. You know what I think about this. Then you probably would have heard about breakout pullback trade, tightness. A lot of people talk about it, which really annoys me because the context they talk about is really, I don't know what they do. Then you probably would have heard about the cheat entries, pocket pivots. Some of you might have read about this 1, 2, 3, or something like that. And a lot of things around the inside bars. A lot of things are made around the inside bars. I'm not really aware, but I've heard a lot of things around these things. Then we also have these narrow range NR, something like that. See, the thing is, these naming these things are good for people to teach, but that is all about them. If you see everything, behind these kind of stuff, behind these concepts, is what the core concept is. If you get this, you won't be caught up with these kind of terms. Because see, what happens is when you learn through namings and all these kind of stuff, you basically attach a lot of ego to it, right? Then what happens is you become a little biased. Let's say there is a stock which is not giving you cheat entry, but it is giving you a good breakout pullback. But since you say that I'm a cheat entry player, you will simply miss out a great trade, which is of breakout pullback nature, right? So basically, this is the point. Don't attach yourself. Simply get the concept which I've given over here through these 3 pictures. Now see, what will happen is you will have a buying force. The price will come down and then it will again go. That is one way. Second way, you will see price again. Let's say this is the continuation of this. Price goes up. You see that it comes down, and from here onwards, you are expecting the price to go up. But in fact, what it happens is it goes to much lower low. Then it again comes up, and then it gives you the move which was happening here, right? So you see that this itself is coming twice in here. Okay. Then what happens is you see that this happened, this move. You made lower low this time. And like in this diagram, you thought that from this point, this will happen, right? So you started buying here. But what happened? The stock made another lower low. And then finally, the stock went up and gave you this here. Okay. Then it again went up, gave you this here. Then the stock again went up and gave you this thing over here. Now see, what some people will do, some people will call this trade as a tight trade over here, pocket pivot or inside bar. Okay. Some people will call this a VCP or a cheat entry over here or tightness. Some people for this trade, here they will call you cheat entry, pocket pivot, 1, 2, 3, whatever. Here they will call it tightness. Here they will call it breakout pullback. What I'm trying to say is if you really get the concept behind these things, you will be massive success. And these 3 pictures are something that if you really understand the concept which I'll teach you on the charts, there's not anything left out. Everything that these theories have to teach you is covered in just these 3 pictures. It's just that you have to understand. I'll give you a simple understanding here. Let's pick a first diagram. Let's say that this move is of 10%, right? Okay. Let's say that this move is of 40%. Let's say this move is of 80%. Now for 10%, you simply came down for once, let's say 7-8 days, and you went up. I think that makes sense. For 40% move, is 6-7 days of consolidation worth it, even if it is coming to your favorite 10 moving average? Well, I don't think it is, which simply means it might go to its 20 or 50 moving average. So you wait for that. Basically, whatever the up move is happening, you have to wait accordingly. If the up move is of 6%, you will probably wait for 2, 3, 4 days. If the up move is of 40%, you will have to wait for a longer duration of time. Which means, in these cases, you will find VCP forming, generally. Let's say the move is of 80%. Now, tell me, for 80% move, will it stop at 10 moving average and give you another entry? I think not, right? It will probably go to its 200-day moving average as well. Okay. And then again, in these kind of cases, you will see 1, 2, 3 inside bars, pocket pivot, cheat entry, tightness, all kind of things happening. Why is that? Because there is a lot of ground for the stock to cover. So basically, it will give you a lot of different kind of opportunities. But if you truly understand the nature, you will simply ace it. How is that? Let's say you are here in this stock. Okay. Now this move will be what? 8%. And it comes down to its 10 moving average. Definitely, that is a good entry point. All right. Similarly, let's say here you are at 10 moving average. But before that, you have a 80% move on a daily time frame. Now here 8% move, 80% move. Definitely this will work and this will not. Why? Because now you understand the concept, right? This 80% move will probably come to its 50 or 200-day moving average. That is where it will work. Why? Because of the 80% move. So these are some simple things that if you really conquer about the entry points, this concept, then you don't need to subscribe to any of these kind of theories that people out there are simply preaching without actually understanding. Okay. So more on this entry points on the charts, because I think with the real charts, real world examples, definitely, the understanding will be much better. Now, the last slide of this is your exit points. Okay. So I'll give you some more points. The first thing is simply identify the time frame where you saw the opportunity at. See, if you saw that the opportunity was in monthly, then monthly is where you need to be aware of the scale of and be patient. Which simply means that let's say you saw the setup or whatever you look for on a monthly time frame. Then when that monthly time frame starts to move, the move will be of the scale of monthly. Because what can happen in a month is stock can go 80 to any percent that you want. 20, 30, 40, 50%, anything according to its DNA. Right? You understand that? So what you have to do is simply wait for it. Be patient. Since you are trading on a monthly time frame, the monthly time frame needs at least 3-4 months to give the entire move it has to give. So patience of that much is required. Now there is one key to manage your positions when. That is to simply go a time frame below it. Now let's say you are trading on a weekly, you can go to daily or even hourly. Let's say you are trading on a monthly, you can go to the weekly or daily. What you can do is you can trail your position. Your stop loss can be used of any moving average you like. You can use 20, you can use 30, 40 or 50. I would say stick with the 51 on daily time frame or below it. So I'm assuming that you are looking at the monthly. So what you will do is your stop loss will be the daily's 50 moving average. Because seldom you will see that the stock which really have to give you those big percent returns will come to 50 moving average probably once in the entire up move. I'll show you the examples as well. And the last point is simply that, see, you have to detach yourself. After all the technical stuff you have learned, taken care of, just detach yourself, close down your system. Once your entry is done, position size is managed, and your plan is ready, written on the paper. Close the system and just enjoy your life. Enjoy the time that you have now, because most of the people come to trading to get freedom, right? To have free time. But what they instead ending up doing is being stuck to their system for hours for pointless reasons, for just watching what the stocks do, right? So I believe even when you take care of the technical stuff, but the fourth point, if you miss the fourth point, I think you are just undoing all the hard work that I'm doing for you and you are doing for yourself. So see, this was all the technical stuff. Now let's jump to the charts and let's see some really good examples to all these concepts that we have seen here, to infuse them together and see how they behave on the charts. So now we are into the part 2 of the video, wherein we will take a lot of case studies, a lot of charts, which we will study. And if you watch this part, the part 2, with a lot of focus, then you will be able to get all the knowledge with a lot of depth that you have consumed for the past 45 minutes. So see, I've written 3 things here which are very important, especially putting that knowledge into the right perspective. The first thing is about candles. See, any chart that you're watching, it should have good candles. What do I mean by that? Let's say we are analyzing a stock which is going up in an uptrend, okay? This is what the template also mentions, that the stock has to be in the uptrend. Okay. Now, when you analyze this area of the uptrend, the price is moving up. Check for the quality of the candles in that up move. Let's say that the stock is definitely moving up, but when it goes up, the candles are of this quality. That is a lot of volatility, right? And the bodies are small. This is not something you would want to see. While on the contrary, you could see that there is a stock which moves up like this, which is candles, wherein the open and low are the same, and it is closing near to its high. Majority of the time, not always. So basically, these are the candles you are looking for. Good looking candles. So you will come across a lot of charts when you scan that they will have candles like this. A lot of wicks on the either side, either on the upside or the downside. That is something you have to avoid. Okay. The other thing is, let's say that there are two stocks, stock A and stock B. Let's say both are in uptrend like this. Let's say you identified an opportunity in both of the stocks here. Now you saw that in this entire up move, the stock is capable of moving 20% or so in 4 or 5 months. Okay, this stock number of stock A, while stock B in the up move of the uptrend is capable of moving 300% in 5-6 months. Now the question is, you come across these opportunities here, point this and point this. What will happen is a lot of people will not look for these kind of data that is presented by the stock to you, and they'll simply put 50% capital here and 50% here. While some will put 100% here and completely ignore it for some reasons. That should not be the case. Because see, when you do such kind of things based on ignorance, this leads to the underperformance. Yes, both the stocks are going up in your direction, but this has given you 20% in 4-5 months, while there was another stock that was capable of giving you 300%, right? So these are some small decisions, that actually play a very big impact in your account growth. So make sure that you don't make such kind of mistakes. Always see the DNA of the stock, right? As I always talk about it, and then take the decision. So stick to this stock. And if you wish to still participate in this, probably put 20% only of the intended amount, and rest 80% can go over there. So this thing is clear. So the candles have to be good. And this is something about the DNA you have to see for the stock. If you are not sure what the DNA is, please check the free Academy lectures that are available in the playlist section. Those will really help you. Then comes the second point of chart structure of support and resistance. This is very important. Let's say, we'll talk in some more detail now. Let's say that there is a stock which went up and then it corrected. Then from here again, it started to go up and then it started to come down, right? Now, see, these are very obvious points that you have to mark. You have to mark the previous resistance because that is now going to act as support. And this is the area wherein you have to look for buying opportunities. We'll see more on this when we see the charts in some minutes. But these are areas of a lot of importance. That is one thing. Another scenario can be, let's say that the stock moved like this and then it corrected and now it is trying to move up. Mark this resistance and pay a lot of attention to what the stock is doing just around this area. This will come really handy when we will explain things on the chart. So these are some concepts and areas wherein you need to be very alert. So pretty simple. After that, what you are supposed to do is put the moving averages. Now, what moving averages you have to use, or I personally use, I use 10, which is my favorite on any time frame, then 20, then 50, and then 200. These are the moving averages you have to use on any time frame you are. Okay, so now this is clear. After you have seen the candle quality, how much the stock moves, then you will mark the chart structure, that is your support and resistances wherever you see in the chart and which are relevant to you. And then you will use the moving average knowledge that I'm going to give you. So I hope these things are clear to you. Now what we will do? Now we will go on to the charts and see some real examples on how you could have managed and what exactly this setup gives you. Okay, so the first chart that we are seeing is of Schneider, and we'll look into great detail how you could have used this. So see, what has happened here is, first thing that Mark talked about was trend, identifying the trend. And see, how I'm modifying the strategy for you is what time frame you have to use. You have to use the monthly time frame. We'll use the weekly and daily as well, but we'll use monthly because you are looking for multi-baggers. That means you are basically looking for 100%, 200 or even 300% movers. So how to deal with those? See, first of all, switch to the monthly time frame. I'll give you a scan for this, and once you are completed with the case study. Now, what do we have to look for? Is a trend. And I can see that if I mark the trend in this stock, there was no such trend until this happened. Right? This is the area where I saw the uptrend coming in. What I'll do, I'll simply first mark this because this is a great deal of importance area, and then the second here. Correct? So this was a resistance which created a high. Then we had a higher low here, which then led to the break of this. So now we have a higher high. And this area here was the making of a higher low. Right? Okay. Then let's talk about that what I told you. I told you to look for the candles, the quality of the candles when the stock is moving up. See this quality of the candle here. See these candles, right? The open and low is the same, closing near to the highs. And the same thing is being carried over here as well. So that part is good. Then you have to see when the stock is moving up, how much does it go? So let's first measure that. From here it went 68% in a matter of 2 or 3 months. Here also it went 96%, right? So then this tells you that you are in the right hands. You are at the right place. Because let's say if the stock is not even capable of moving 30% in 6 months, what's the point? But here I can see that is the stock can touch the figures of 100% and so. And on top of that, I see that my stock is going to go for the all-time highs it has had. And all-time highs are very important areas. Because once they are cleared, with a solid buying force by the monthly buyers, the stocks generally go on for a very long period of time. You can clearly see that if you would have bought the stock anywhere here, right now it has given you 160% returns, which is not a surprise because we already know that the stock is capable of doing such kind of returns. Anyways, now let's see how we could have implemented this. So once we have checked the chart structure, support and resistances, what do? We plug in the moving averages. So here we go. These are the moving averages. I'll explain. The black one is 10 moving average. The blue is 20. The green is 50. The candle colors, well, you don't have to worry about them. All you can just know is that the dark blue ones are really bullish candles. The dark green ones serve the same purpose. That is basically all about it. So then we saw that our stock gave some really great candles, before which all the moving averages were what? Together. True, right? After which, this was the first time we got out of this resistance. We broke the resistance, came out of the range, and now we are in the uptrend. How do I know that? Look at the slope here, upslopes. And this is the first time I'm coming to the 10 moving average of the monthly. Is that right? I hope you are able to understand this. And once the price is coming to 10 moving average, see how it is coming. Look at the body of the candles. They are very small candles. True? Okay, once you have done that, what you are supposed to do is you simply print this area of 10 monthly moving average. Just draw area highlighting that area. This is the area, right? Highlighting the area near to the 10-month moving average. Okay. Now what you will do? So see, What we are going to do in the strategy is we are going to scan on the monthly time frame. I'll give it to you and I'll explain that. The scan will give you stock here. When the month of September ended, you would have scanned and the stock would have looked like this. This is where it will come into your watch list. Now, your job as a trader would be one thing, to wait for the stock to come to its 10 monthly moving average. That is one thing. The other thing that can also happen is it might not come to its 10 monthly moving average. How will I know that? I'll explain. But for now, let's consider the simple case that there are good round of buyers that come in the monthly, and there should be some event happening. As I've talked about it, that is the crossing of the moving averages, that is one, or you are coming out of the range, which you can clearly see it here. Okay, in those cases, when the first time the stock price comes to the monthly 10 moving average, you really get good buying opportunities. Now I'll show you something. If you switch to the daily now, there will be a red line, which is basically your 200 moving average. And see where the buying opportunity was, where the box is drawn. The best buying opportunity the stock provided you was at the 200-day moving average over here. And when you follow this, when you do this, you will be able to really get out almost at the bottom of the prices. At dirt cheap prices for very minimal stop losses for potential very, very big movers. As you can clearly see, we are seeing it right in front of us. Right? So, there are a lot more examples similar to this. Now, let's see one more thing, okay? So, this was the case when the price came to 10, right? I'll explain in detail more. Now, let's see the case where the monthly doesn't come to its 10 moving average. As you can clearly see, as of now, it is happening. Okay. So, here, since it is in watch list and you know that you're going for the all-time highs, and look at the fashion the stock is moving, it is pretty good. So, it should always stay in your watch list, right? So, let's say this is in your watch list, and what you saw here is the weekly. What did the weekly here do? Weekly gave me inside bars right at the 10 moving average. Okay, that is one clue that you have now, that my monthly might not come to its 10 moving average. While in the previous cases, what was happening is you did get inside bars, but the high of those were never broken, and you actually went to the 50 of the weekly as well. While in this case, what was happening is when the high of the inside bars were broken, see the kind of move that you got. Now, if you switch to the daily, see what was happening. Look at these dark green candles. They give you the clue that your monthly is not going to come to its 10 moving average, and you can have your buying here. And, in just a few days, not even months, you can make some really great returns, right? So this is how what will happen is over time you will create, or you will have a very strong stock watch list, which will come handy for years because we are talking on the monthly time frame. Now let's take another case study here. It is of the Subros, and here you mark this resistance, and the scan that I'm going to give you will give you a stock here. Now when you're scanning here, what has happened? 10, that is the black line, has crossed above its blue line, and you are near to the all-time highs, correct? So there is a special event that is happening. Now what is your job? Simply wait for the stock to start consolidating or come to its 10 moving average on the monthly. True? And when it does, that is where you get active. And see, the stock is already given you in matter of how many? 2 months from here, it has given you somewhere around 40%. True? Let's see the weekly. See, again, the weekly never gave you good inside bars anywhere here. The stock was simply too volatile. And it eventually came to where? Weekly 50 moving average. Let's see the daily. The daily was at, again, 200-day moving average, providing you the best thing. Now, you will question that, okay, how do I know when to buy the stock? How will I know that this is the place where I need to buy the stock? Now, what we'll do, we'll simply go back to the whiteboard and I'll explain it to you. How to enter these stocks, how to basically play these opportunities. Okay, so now let's see that what exactly will happen on the charts. So what we are doing for is, we are looking for the opportunities on the month. monthly charts. That is where we are looking for. What we are looking for, strong candles, and then wait for them to consolidate. Now I'll give you two scenarios. Broadly, there are two scenarios only that you will face. That is, let's say your 10 moving average, this is your 10, and this is your 20, right? What happens is monthly was, let's say, in a range. Then a good candle comes, and then it comes to basically 10 moving average and gives you another solid move. How it will look like? The moving average, it would be something like this, right? So there is an event here that is 10 crossing above 20, and then the price comes to 10. This is how my monthly would be. Now, if you simply check the daily of this stock, what you will see is, let's say the red line will be our 200-day moving average, and the yellow line will be 50 moving average. What you will see on the daily is there will be a lot of buying, and then the stock will be doing something like this, right? Okay, now pay a lot of attention. What the stock will do is create a low, go up, create another low here, and then do this. Now tell me what exactly is happening. And this pattern will be made, which you see here, near to the daily 200-day moving average. Over here, you have to look for VCP or VCC. Well, if you are familiar with this channel, then you will not use VCP. You will say that you will look for a VCC happening at daily 200. You will look for big red candles followed by demand candles. That is the big green candles as well, or at least the area of tightness. That is where you simply have to begin your buying, with the SL being these levels, right? And this will only work when the monthly satisfy these all conditions. Only after doing this, you have to go here. You cannot say that if the daily is at 200, it will go up. Never. If the monthly is in this configuration particularly, then only this will happen. Otherwise, it will not. I'll show you the examples. So basically what you have to do is you have to look for the tightness or the VCC being formed around that daily 200 moving average. Simply place your orders over there. Keep buying the quantity like a smart money accumulates, in every week buy some quantity, keep buying that. And then when the move will come, you will definitely make a lot of money. So this is one case where the monthly comes to its 10. There will be a lot of cases where the monthly will not come to its 10 moving average. The question is, how do we deal with that? The answer is pretty simple. I'll show you. So the moving averages will remain the same like this, 10, 20, 50, 200. What will happen is your, let's say, monthly has been going up like this, and it just consolidates for a while and then again gives you another move. And if you go by the moving averages, your moving averages would be away. The 10 would be away from the price. Okay. What will happen with this is how the monthly is. What will happen is your weekly will give you the clues, or your daily will spill the answer. How is that? I'll explain. See, in these cases, how the daily will look like. The daily will look like this. The price is going up, and then what happens is it starts consolidating like this, which you call as VCP, which is again VCC. But what you will observe is in these cases, my 50-day moving average will be of crucial importance, along with 10 and 20. But I'm not doing 20 here for the cases. Sake of simplicity, keeping the charts clean. What will happen here is that when you have the monthly criteria set, the monthly starts contracting. And when the daily will come to its 50 moving average, it will give you strong green candles. The characteristic of that will be open could be almost similar to the low on good volumes, and following which the consolidation will be on very, very small volumes sideways, which will mean that this is the daily, which means that my weekly, will simply keep oscillating around its 10 or 20 moving average, and the weekly itself at 20 moving average will give you candles which look like this, long wicks basically. There will not be any bigger red candle, and even if there is, it will be immediately followed by a solid looking green candle. This, if happens, will tell you that monthly is not going to its 10 moving average. Rather, it might just stay in the air, and from there onwards, you might get a move. The daily will spill the beans. While in the other cases, I'll show you that when the monthly comes to its 10 moving average, the daily simply breaks below the 50 and keeps going, moving towards its 100. So these are the true broad scenarios that now we are going to look in detail on the charts. So here we are, right? Now see, what happened here is, when the Subros came to the 50, just look at the candles that are being formed, big red candles. And you went down, which eventually led to what? 10 and 20 went below 50. And they basically went into the range. This candle came in just too late. Okay. Then I'll mark a few things. That is the higher highs and higher lows. Let's start from here. This is how basically the stock moved, making lower highs and lower lows. And here what happened is this. Right. So now can you clearly see that I made a 200-day moving average? You will mostly see that there will be very volatile days. That means, see, this is a 6% down day. The next day is only minus 0.83% down. And after these days, these two big red days, which had no volumes, we had up days as well of 3%. And following which, again, we had small body candles at 200, which is a VCC information forming a higher low. So what you can do is simply buy here. And then you will get the benefit of all this happening. And why did this move happen? Because on the monthly, we had this candle, the 10 had crossed above 20, and there were no big red candles coming to its 10 moving average. That is why you are getting this move. Right? So this is just one example. I can show you more. Even in this stock, if you go back and see, let's do that in fact. I'll mark this area of resistance here. And this is the area, right? If you see, did not actually come to its 10. It was a little away from its 10. So let's analyze and let's try to see what happened over there. How was the weekly and how was the daily? So see the behavior of weekly at its 20. See this big red green candle? The open and low is almost the same, closing near to the highs, right? If you see it on the daily, what you will see? Let's see. See the quality of candles whenever it came to its 50. See this again went up. Here again, it went up, right? And 20 always remained above 50. Never went below. And over here, it gave you a solid opportunity to enter the position. And then you could have made a good amount of money in a short duration of time, right? And if you could have holded the stock, you could have made much more. And then another scenario, if you see, when the price actually came to its monthly 10 moving average, let's analyze this area as well, how you would have handled this. But again, now there is an important concept. Is this the first time price is coming or consolidating? That is not. This was the first time, right? So this is also important. The first time is always the best if you can get it. But anyways, with the knowledge that you have, you will be basically able to buy really at the bottoms. Now see what has happened here. The stock kept falling down, right? And then what happened? A big volatile day happened. After that, you had the opportunity to enter the some positions here. Now what you will do is your SL will be in this zone, right? And then see the behavior of the price exactly at the region the price came before. This becomes your another buy area. Why? Because this is a support region, right? This becomes your buy area again. And then you can simply see how the stock moved after that. From 50 rupees to almost 100 rupees, right? That is an amazing move. So this is how basically you have to infuse all the things that you have learned. Let's take another case study. So let's analyze this stock, and the stock scan will give you the stock on this month, okay? Now what you have to do, you can clearly see that the uptrend has begun. We are going towards the all-time highs of the stock. How is that? Let's see. Let's mark the higher highs and higher lows. This was formed here. So clearly now you are starting to move up, right? And over here, this was the first time you are coming to 10 moving average of the monthly at this juncture. Okay, now here you will say that it doesn't look good the way it has come, big red candles. That is definitely one thing. So let's go and see what the weekly has to say about this. So what we will do is mark this area and let's go to the weekly. So what the weekly would be doing? Any guesses? It would be at its 50. And see, when it approached 50, were there big red candles or the candles had a lot of wick? They had a lot of wick. So you get a lot of inside bars in the weekly chart. At 50, 20 is always above 50. That is another good thing. Let's see this area, of this inside bars at 50 of the weekly, this entire area on the daily chart as well, right? Because that is where we will be buying the stock. Let's go to the daily. Amazing. See how it is approaching and see the kind of candles you are getting at 200-day moving average. 4% up. The stock is 4% up. The open and low is the same. And mark this area. Right? If you want to see this clearly, the structure clearly, what you can do is you can further go down to the hourly to see it better. So let's see, the structure will be visible much better over there. Right? So is this not a VCC information? All right. Then we led to the up move. So this is the area. And this is simply how you have to buy. And if you could have bought the stock here, let's say anywhere here, this stock went 400%. And see, for only once, the stock came to its 50 moving average. And that is also taken care of because when you saw the stock that it is capable of moving 300% and such big numbers. So here also, similar thing only happened. So you will simply be patient that if you know the stock is capable of doing this, it will definitely do it. And in how many months did it do this? 1, 2, 3, 4, 5 months. Is that not good? Is that not great? That is, we can see more such examples. You can see it here. Now see what happened. This was the candle. The stock scanner will give you 10 crossed above 20 and then you had one inside bar on the monthly, right? So let's see it. How does it look on the weekly? It will be at 10 moving average of the weekly inside bars. Before that, there is a solid looking candle leading to a special event. Okay, let's go to the daily. See how the stock is behaving at 10 and 20. Always coming up, rejecting to go down. How do we know that? Look at the quality of the candles, dark green candles. That means that area between 10 and 20 on the daily then becomes your buying area. And this proves that monthly is not going to its 10 moving average. And you simply got the move. Another case study. And this is the stock we are seeing. A really good stock. So let's see what was the trend here because that is important. So we see that this was happening. Right. So at this point, that is where you are interested. The scan will give you the stock here. Right. 10 has crossed above 20. Solid looking candle. And where are you? You are very near to the resistance. And for the first time, you're coming to its 10 moving average. Let's see what the weekly was doing at that time. See how the weekly was reacting when it came to its 50 moving average. See the volumes compared to the down weeks. Much higher. And then you had inside bars on the weekly. Let's see how the daily was. Simply look the behavior of daily at its 10 moving average or 200-day moving average. See this candle, high volume, 6% up. These are the areas where it becomes a buying opportunity. And even if you buy here with a SL of what? 6.23%, simply look at the rewards that are waiting for you. If you really see it, it's almost 142%. 142%, definitely a great deal of patience is involved from March to almost December. But 142% is something amazing through a single stock, right? So, when you combine these learnings of VCC and moving averages of market, of how the candles move, how the DNA of the stock is, the special events, the fundamentals, if you require, although I have shown it to you, that just through the stock technical knowledge and the stock scanner I'm going to give you, it is very much possible to even bypass your fundamentals. Although that is something very personal, dependent on you. But yeah, this is why, when people say don't buy stocks below 200-day moving average, it really doesn't make sense to me because they simply just don't have the right perspective about the stocks, because these are actually the areas which provide you the most value for your money or for your risk that you're going to take. Let's pick another case study, that is of the IRFC. Here the stock will come in your scan 49% in a single month, goes into the all-time highs, breaks out of a very, very long range. Okay, so now what you're supposed to do? Simply wait for the monthly to come to its 10 moving average. Let's see what the weekly was doing, because this is an interesting stock. A stock, that we should definitely study. And see this now. The weekly came to 50, and simply see how the weekly is coming to its 50 moving average, small body candle, right? Now, I think you are pretty familiar with what you are supposed to do. You go to the daily and you know what is happening. See the behavior, see the kind of candle that is being printed at the 200 day, and see the volumes rising on the up move. And then you get, this is what? A VCC information, right? That is where you could have entered. And let's say, what is your SL? If you want to have 7%, for what potential gains are you having that? Well, the potential gains are of almost 230%. Definitely a great deal of patience is required. But once you have these kind of stocks, you know what you have in your hands. So you will see that the stocks which are breaking out of the range, an event has happened, that is 10 crossing above 20, and going into the all-time highs, those have to be your priority. And here also, if you will see, I'll show it to you, that here you will say that, okay, the price did not come to its monthly 10 moving average. Well, let's see what the weekly was doing, because that will basically give you hints. See the behavior of the weekly, see the kind of candles you have compared to the previously. See these candles, compare it to these candles, right? And if you will see the daily, you will see it will be at its 50 moving average, giving you solid candles. See these candles small at the 50-day moving average here, and you got the move. So that is how it happens. And if you combine that, just see this very volatile structure. No small candles are over here. Here the stock went 9% up. Previously it was down 10%. Similarly, it was up 6%. The next day it is down 5%. So this is not the volatility you need. You need very cool structures like this. No volatility, absolutely. This gives you, or this tells you, that this stock is not going to go to its 200, which simply means not going to its monthly 10 moving average. So Kalyani Jeweler, I've put this case study PDF in the Telegram group. So make sure you go over there, see the pinned message, you will get it over there. What happened? Look at the solid candles this hard, right? Came to its 10 moving average for the first time, out of range, going into the all-time highs. You see the weekly, see the behavior of the weekly at its 50 small body candles. I'm sure you'll know what the daily would be like. See the behavior at the daily. See these volumes coming in, right? So this becomes what? Your buying area. And after that, simply see how clean the moves are. And if you would have bought here the stock, let's say in this case here, keeping this as SL of 5%, what are the potential gains we are looking at? We are looking at 240-230%, right? And also when you combine these moving averages with support and resistance, things will work wondrously. See this. This was the support created by the stock, a very strong one. Simply see how the stock reacted around it, right? Pretty good. Now I'll give you an example where the monthly will come to its 10 moving average but will not give you a setup. What happens in those cases? Pay attention. So in this case, you will say that, okay, here you are interested in the stock because it had all the criteria met, came to its 10 moving average. So you look for the buying opportunities. That is what you will say. But eventually what happened is the stock actually went to its 50 moving average. Why is that? Let's see, and how we could have decoded this. So we go to the weekly and see the behavior at the weekly 50 moving average. See this candle, 18% down, closing much below its 50 moving average. This is definitely something you wouldn't want to see. So in the first place only, this is a warning sign. We don't want to see that. And even if that happens, You immediately want your next week to be a solid week, recovering for all that has happened, which never happened in the stock. It always struggled to go up. Let's analyze this area furthermore on the daily. How did it react? Because we need very solid reaction on the daily 200 moving average as well. If you don't have that, you are in a lot of trouble. What happened at the daily 200? Simply see how it went down, right? Never a good thing. But let's say you then counter and say, oh, there is a good recovery and there was a area to buy. I will say, okay, fine. You may choose to ignore everything else and you proceed to buy her. You want to see what happened after that. Let's say you bought her, keeping the SL what? 10%? And I think 10% SL is definitely fine, especially when you're playing for 100, 200% moves, right? What happens next then? You are in the money and then you almost make 16%, or even if the price comes down 2%, then again goes up 16% up. In these cases, what you can do is you can simply shift your stop loss to either your cost, which is over here, or the latest higher low, which is here in this case, over here. Because if the buyers here, which you see are really strong, they will not let the price again come below this level. But when the price comes below this level, you know that the stock is now in trouble. And even you took your bet, you took your chance, you'd lost, if anything, not a lot. You just came out at the cost, or you actually made some amount of money. Definitely a lot of time was went, but still you are not in any kind of serious drawdown. Through this, what happens is, because you are now timing your entries in such a precise manner, that is the whole goal of Mark Minervini's SEBI, that even if the stock doesn't work in your favor, it doesn't work for you, you will not come out at big losses. And if you remember, this is what I said in the slides as well, that even if the pattern is wrong but the execution is right, either you will have a minimal loss or you will come out with some profits, which in the long term will lead to better performance. And this is exactly why I've chosen this stock for you to have a look. And also, if you're thinking, what happened actually with the stock, the monthly went to its 50 and see how it reacted, which is weekly 200. And how weekly 200 reacted, simply see the reaction. So you could have bought the stock here as well. After watching this video, now you have the knowledge. There is no excuse for you after watching this to not make money. Simply, there is no excuse like that. So now I'll take the last case study before we move on to the scanner I'll give to you. That is a Wabag. Very interesting name, as it gave you, two opportunities here. See, the first opportunity came here. Look at the candle, 30% in a single month led to what? 30 or 10 moving average crossing above the blue line 20 of the monthly, and you had a resistance here. Right near to the resistance, you were consolidating. Correct? And the trend is also changing. You are having a higher low, right? Then now you are having a higher high. Okay, let's see this area on the weekly. The weekly was here. See this area? See how it is reacting at its 20 moving average every time. Such solid looking candles. Let's go to the daily. How did the daily react? See it here? There was not a lot of space, but every time it tried to go towards the 200, there was a solid support, which is clearly visible. Look at the candles here. Every time it took support here. So what you could have done, once the support is established here, you need 2 touch points. You can start entering in these areas. Right? And then simply see how the stock moved from here onwards. Then again, it did a very similar thing. Go to the monthly. It came to its 10 moving average, which on the weekly you will probably know. See, now again, it closed below its 20 moving average. Pretty bad fashion. That is not a good thing, right? But then see how it recovered. Look at the volumes, look at the candle. Yeah, there is an element of wick on the upside, but that is natural when you have had such big red candles on the left-hand side. The open and low is the same. You go to the daily, what do you see? You see such good buyers. So what happens is this area, this VCC area, after such strong buyers on the daily, becomes your buying area. With SL of what? Let's say you bought somewhere here. SL is 10% again. And still the stock is going up. It has only given 36%, but I'm pretty sure when you will look back this chart after some time, you will definitely see the stock into the thousands, or at least coming into the 700, 900 numbers, right? So this is how, when you time your things, when you time your stocks, even when it goes wrong, you don't really lose a lot of money. And when you're right, you're making much more. So now let's go on to the scan. So now we are on to our scan, which is called as monthly SEBI, and I'll guide you through these queries. So the first thing is the monthly percent change should be greater than the number 20. That is 20% or more than that move should be there at least. I've used this filter of RSI. I'll teach about RSI as well later, but the monthly RSI should be greater than number 50. Then the monthly 10 moving average should be more than its 20. The daily volume should be more than 50,000. You can play around this number if you want some illiquid stocks. If you just want to build position, slowly, then you can play around this number. You can have it 10,000, 20,000, whatever you like. I would keep it at 50,000, but you can definitely play around this number. And then you have to look for the stocks which are closing above 20. Well, see, what will happen is most of the stocks in the markets that are liquid, tradable, will be more than 20 rupees. There are some stocks which are really liquid, but below 20. You can scan for them manually and just select them stocks, but it's better if you leave this query on here. Then comes the important part. Now see, either of these things will simply work for us. First thing is that is in the last 20 months, my 10 should have crossed above its 20 moving average at least once. Or the monthly closing is crossing above its monthly 10 moving average. Either of these is fine because these two are special events that we are looking for. Once you are done with that, you simply have to run this scan at the end of the month every month, right? So whenever 28th, 29th, 30th, whenever the month comes to the end, near to the end, and you have time, simply scan this, and on an average, how many stocks you're getting? 34 stocks. If you simply scroll down, see, what happened is the month were 30-50 months, 30-50 stocks you were getting in the monthly scan. That means the market is consolidating. Then when the market actually went really good, you got around 120 stocks towards the end of the November. Now again, towards the end of the December, I believe we are going to get around 40 stocks or around that, below that. That means now these stocks which moved will give you the opportunity in the next 4 or 5 months. So you simply have to scan these stocks, keep this in a watch list, and simply wait for these stocks to give you either set up at the weekly 20 moving average or monthly 10 moving average, right? See their behavior, how they react on the daily 200, and start building your positions. And through this way, there is just no way that you don't make money through investing. And I'm not talking about simple money, 30%, 20%. I'm talking about multiples of 100. It is as simple as it can be. This is the simplest and I believe the most comprehensive analysis you will find it, right? So this is the scan. I'm linking this link in the description. So please get this from there. And with this in-depth guide about that entire book of Mark Minovany's Trade Like a Stock Market Wizard and every practical detail that you wanted, and I've tried to keep this video as short as I could have without compromising on the quality. I've given it to you. Now there are a lot more other free resources available in our public Telegram group. The link of that is in the description. And there are a lot of case studies. The one case study I've attached in the group of Kalyan Jewelers. We saw the stock in this video as well. And this is an in-depth, I think around 18 pages of PDF I've created. You can find it in the Telegram, so download it from there. And there also you will get a lot of deeper understanding, even better understanding, right? To further complement with this video. So make sure that you let me know in the comments how this was. And I'm pretty sure after 6-7 months, I will get good emails of people making a lot of % returns on their capital.